Hello, very good morning to all. I'm Kelvin here again. Welcome to today's Daily Dose of Market Insights. Very good morning. Today will be Wednesday, the 18th of September 2024. So as usual, before we start our Daily Dose of Market Insights for today, let's have a quick look at the disclaimer first. All right, leverage trading carries a high degree of risk and may not be suitable for everyone. Losses can exceed deposits. This presentation is not an offer or solicitation to buy or sell, nor financial advice or recommendation for any investment product, as well as any forecast, prediction, projection in this presentation is not necessarily indicative of the future or likely performance of the product. This advertisement has not been reviewed by the Monetary Authority of Singapore. All right, so as usual, we will have a first rundown of what has taken shape yesterday in terms of economic data releases, news events, and their impact on the various cross-asset classes price movement on an intraday basis. So as we know that today is a pretty important day. Why? Because in terms of the global financial markets, it will be the widely anticipated US Federal Reserve, Fed, the central bank, FOMC meeting, which is its monetary policy decision. It will kickstart around 15 hours from now. And as well as it's being widely anticipated, the Fed will finally cut its interest rate after putting it on hold for close to a year. All right, close to a year. So right now, yesterday we do have one key economic data release that is pertaining to the health of the US economy, which is US retail sales. Okay, so let's take a look at yesterday's US retail sales data release, okay, based on the economic calendar. So what we could see over here is that we break down according to the shorter term perspective month of month. So month on month, that means we take into account changes from the previous month on a monthly basis. So month on month over here, the market actually, not the market, the data print actually came in better than expected. So if you look at the data print for the month of August, it came in at 0.1% month on month, which is better than what market is expecting. So market is expecting negative growth on a month on month basis, negative 0.2%. And also the previous month figure of July was revised upwards slightly higher to 1.1%. Okay, so but if you were to shift up from this very short term month on month basis on a year on year basis, that means we're talking about taking into account of August print versus the print of August a year ago. That means we're talking about August 2024 versus August 2023. The growth figure actually not so rosy. Why? Because it actually slipped slightly lower to 2.1% year on year from 2.9% year on year that was printed in July. And this 2.9% year on year was also slightly revised upwards from 2.7. So if you look at the retail sales on a year on year basis, removing off the short term month on month fluctuation, we see that the growth since March on a year-on-year basis was rather flattish, lackluster over here. Okay, so you put it on the 5-year horizon. Okay, you see it still continues to be rather lackluster or sluggish. And in fact, from December high of 2023, it continues to print a series of lower high. All right, lower high over here. So net overall, right, what we could see in this current state of retail sales data, if you were to combine it from a year-on-year basis and a month-on-month basis, is rather a mixed picture. And given that the year-on-year figure is not so rosy, market participants in the interest rate Fed funds futures market, according to the CME Fed Fund 2 data compilation, is still looking for a very high chance of a 50 basis point cut in today's FOMC meeting. That means you look at it this over here. So current rate is at 5.25%. If you look at my screen, okay, let me expand my screen so that you guys could have a better visualization of it. Okay, so current rate is 5.25% and 5.5%. So this is the highest rate that the Fed bring it to in the previous interest rate cut cycle to almost a 2-decade high. Then thereafter, they pause it for almost a year before deciding to give very clear indication that they will move in today's FOMC meeting. So now it's either a 25 basis point cut or 50 basis point cut. But what the interest rate futures market, the Fed funds interest rate futures market, is pointing to a 65 basis point cut after yesterday's release of the US retail sales figure. Why? Because you get 5.25% minus off 4.75%. That's give us 50 basis point, and it gives us a high odds of 65. Hey, look at how the odds changed across the week ago. Previously, 1 week ago, it was at 34%. A month ago, it's only 25%. So right now, it's really deeply increased of 65%, whilst the previous 25 basis point cut previously at the start of a week ago was very high at 65%, and after a slew of so-called news report from Wall Street Journal, then we have the ex-Fed president from New York, Fed Daly, writing in a Bloomberg opinion piece urging for a 50 basis point cut by the Fed 2 days before today's FOMC meeting. So all that tend to skew the pricing of the Fed funds futures market in terms of the trading and anticipation of today's move to make it very high at 65, at a 50% basis point cut of a very high odds at 65% chance. So if you put it across the curve on the aggregate basis over here, okay, we see it this particular pricing right now. That means high chance of a 65 basis point cut in today. Then thereafter, another 25 basis point cut 2 days after the US presidential election on the 7th of November FOMC meeting. Why? Because it's showing a 92% chance to bring it down to 4.5%. So that's a 25 basis point cut. Then thereafter, another high chance of 65% chance to bring it down to 4% to 4.25%. That means that's actually a 50% implied 50 basis point cut, pardon me, to bring it down to 4% to 4.25% on 18th of December 2024 FOMC meeting. So net overall, right, what market participant is expecting right now, before 2024 ends, the Fed funds rate will be reduced by 1.25%. This is what it means to bring it down to 4.25%. And this CME Fed Watch 2 allow us to actually plot the pricing down ahead, 1 year ahead. That means we get about 12 months from today. Okay, so as of the next 12 months, on the 17th of September 2025, the Fed funds rate will be at 2.75% to 3% at that time. So in aggregate, the Fed from today until all the way down to 17th of September next year, there will be a total of 250 basis point cut as being implied by the Fed funds futures market traders. I mean, how the traders actually trade the Fed funds futures market according to the various calendar down the road. And this data has been compiled by the CME Fed Watch 2. So if you look at this kind of pricing mechanism by the Fed funds futures market traders, it seems to us that there is a high risk that the US economy is about or already slip into a recession, and the Fed is actually late in the game in kickstarting its interest rate cut cycle. This is what the interest rate futures market is pricing. So because of that, if you look at it over here, the performance of the risk asset taking into account of the US stock market was also rather lackluster yesterday. All right, and also due to a particular trimming of any existing open short-term position ahead of today's key risk event. So it shows that in today's key risk event over here is that earlier on the S&P 500 tried to break new fresh all-time high, but can't break above the July high that was printed 2 months ago. Then thereafter there was an intraday sell-off, all right, to end almost unchanged at positive 0.03%. So I would say that this is almost unchanged, and also almost unchanged on the Nasdaq 100 as well. All right, so there was a earlier push up, then thereafter there's an intraday sell off. Similar for the Dow Jones Industrial Average that managed to see a fresh intraday all-time high yesterday, but can't sustain as well, and we start to see this dramatic intraday sell-off as well. Okay, and what's interesting over here is that the dollar index over here, if you look at the dollar index, yesterday the dollar index also managed to shape a bounce off this key medium-term support level at 100.61. Okay, 100.61 is this very clear low over here at 26th of December last year. So yesterday, the dollar index also managed to shape a bounce, okay, trimming a bit of back. So what we could see right now, right, there is actually a high risk on the FX market. What was the FX market is pertaining to the has a higher sensitivity of the interest rate. Why? Because it actually tell us the 10-year and the 2-year mechanism, how they price. So if the US Treasury 10-year and 2-year continues to fall, okay, like what it did over here, okay, at a very steep pace. So this is the 10-year US Treasury yield continues to fall, breaking below the previous key major medium terms former key major support of this 28th of December. It broke down, and what's it indicate to us that the 10-year US Treasury yield is inching down much lower, pretty much in line with longer term interest rate in US will start to fall. Okay, so that is so indicating a sign that inflationary pressure has started to ease off, and there could be a chance of US leading to a softer global patch or even a recession, because the 10-year US Treasury yield is a proxy of inflation growth rate and as well as economic growth rate. And the 2-year is more sensitive to the US Federal Reserve policy. And what you see over here is that this week, not even this week, sorry. Yeah, this last week, pardon me, last week, it broke down below its key long-term pivotal support level that has in place since March last year. Okay, this was March last year, it broke down, which is 3.63%. All right, since because this is a long-term pivotal support level, it's good to see a weekly close below this level. All right, because now notice that it tries to actually form this small little bullish hammer candlestick at this point in time. So if it starts to reintegrate back above 3.63%, there's actually a big risk that the 2-year Treasury yield may start to do that mean reversion rebound. So what I'm trying to express to you all is that currently this 2-year Treasury yield that is very sensitive to the US Federal Reserve monetary policy is also looking for a very aggressive, we call it a push down or selling off. That means market participants are actually looking for the 2-year Treasury yield to inch down much lower because of that much more jumbo 50 basis point cut as being implied by the Fed funds futures market. Now, the next question we're going to ask ourselves over here is that what if Jerome Powell, during the press conference, he sounded not so dovish as being implied by the market? And two things, the dot plot, because today the US Federal Reserve also released the dot plot. So the dot plot actually indicates to us what are the US Federal Reserve median projection in terms of economic growth, GDP growth, inflation growth, this in the next 2 years, as well as where the Fed funds rate will be in the next 2 years as well. So if this particular projection is not so dovish as being implied by the current Fed funds futures market that I shared with you a while ago, as expressed as the data as being obtained by the CME Fed Watch 2, that could see a potential short-term adjustment in the 2-year Treasury yield. That means the 2-year Treasury yield may start to do a bit of spike up. First step over here, it may hit the mean reversion, it may hit up the 3.75% level, which is the 20-day moving average. A level that starts to break out this level may go up to revisit the 50-day moving average that is acting as a resistance at around 4.12%. So once this scenario actually see this scenario starts to push up, we know that the 2-year Treasury has a direct kind of a correlation with the US dollar index as well. The dollar index might bounce from this level over here back to the intermediate resistance at 101.90 that has been in place since the start of this month, 3rd of September. That means it's like a small little what I call pennant formation. Okay, a kind of a pennant formation potentially. Why? Because if you look at it over here, it's something like this, and something like this. Okay, so it's like a more like a pennant formation, a bearish pennant formation, but there is a risk of it reintegrating back up towards the top of the range resistance, which is very close to the 101.90, the high that was printed this month so far. Okay, so in short term, that means that there could be still a chance of some of the dollar pair showing dollar strength rebound. Okay, this I'm trying to express. If Jerome Powell during the press conference, he do not sound as dovish as what market is expecting, or the dot plot economic projection doesn't show a rather dovish implied Fed funds rate cut 2 years down the road. Okay, so something to look out for. Okay, so now with that, that is the key data and its impact on the various cross asset classes to highlight, especially the stock market and as well as the FX market on the share view for today, just based on the intraday movement. All right. So today, there's no very important intermarket dynamics and fundamental share. So let us now jump straight to the intraday technical outlook on the various cross asset classes. All right. But before I do that, let me expand my screen as usual so that you guys could have a better visualization of the chart. All right, so now let us start with the euro dollar first. So for the euro dollar, if we recall yesterday, we do flip to a bearish bias. Why? Because of that bearish divergence that is being flashed out and the price of the euro dollar hitting the resistance level that we highlighted at the start of this week, where we do have a bullish bias at bullish bias earlier late last week at 111.40 and earlier this week as well 111.40 11.60 that's been met. So what we could see over here is that the price action of the this hourly RSI did broke below a parallel trendline support level, now retesting its parallel former trendline support, now turns into a pullback resistance, and now there's a bearish reaction of it this level over here. So with that, we'll still maintain that intraday bearish bias on the euro dollar using 111.40 111.60 as my short-term pivotal resistance level, not support, pivotal resistance level. First level of support level to watch out for on the intraday basis, I will give it a zone over here, 111.90 / 111.70 level, which is also very close to the 20-day moving average. Let me put it 90. Okay, so it's a zone. Okay, so a breakdown below 110.70 may see a further potential push down to test the next near-term support level at 110.50 next, at least on an intraday basis for today. Right, only an hourly push up with a close above 111.60 will invalidate today's intraday bearish bias to see the continuation of the impulsive up move on the euro dollar to expose the next near term resistance level at 112 figure level, followed by 112.35 next. Okay, so that's for the euro dollar. Now, moving on will be the sterling dollar. So sterling dollar yesterday, we also do have a bearish bias below 132.20 / 132.40 short-term pivotal resistance level, and the sterling dollar was much more bearish than the euro dollar. Why? Because it hit the 20-day moving average, which is our first support level at this 135.50. So price action over here, after the way it bounced off the 20-day moving average, pardon me, looks a bit of lackluster by this very small candlestick that it react off it, okay, rather than a large long candlestick. So indicating to us that this bounce so far is not so much of a strong momentum being priced at this moment, and it's all pretty much nature. Why? Because also ahead of the key event risk that is taking shape later at 2 a.m. Singapore time, which is the US Federal Reserve monetary policy decision outcome. So overall, net, what we could see over here is that the sterling dollar still has some chance to actually do another leg of potential slide, and also the hourly RSI hasn't even hit the oversold level yet at this juncture. So using no change, so definitely for sure the 132.20 132.40 will still remains as our short-term pivotal resistance level. We will still maintain our short-term intraday bearish bias on the sterling dollar. A breakdown below 131.50 exposes a 131 figure level next, and even let's say if this price level couldn't hold at 131.30, it may dip further towards 130.40 130.10, which also correspond to this rising 50-day moving average as well. All right, only an hourly close back above this 132.40 will invalidate today's intraday bearish bias, pardon me, to see the continuation of the impulsive upmove sequence to resume its short and medium term uptrend phase on the sterling dollar. First sign to set sign on in terms of resistance will be at 132.65. Above it exposes 133.60. Okay, so that's for the sterling dollar. Moving on will be next in focus will be the Asia Pacific currency against the dollar, starting with the Aussie dollar. So the Aussie dollar continues to actually play around the short-term pivotal resistance level at 67.60 that we highlighted yesterday. And if you look at the RSI, continues to be very persistently shaping that bearish divergence again, as well as in today's Asia session. Can't break above yesterday's high that was printed during the European session. So there was this bearish divergence condition that's being flashed out on the RSI. So with that, I will actually tolerate a bit of noise yesterday's push up using 67.70, which is the swing high or the upper limit of this bearish hourly candle that was formed on 6th of September. 6th of September at 67.70. So a bit of excess at 67.70. So using 67.70 as my short-term pivotal resistance level, I will still maintain an intraday bearish bias on the Aussie dollar. In first step, the first near-term support level to watch will be at 67.30 level over here. Formally, this minor swing high turns into a pullback support level. It's kind of like a pullback resistance support level, and also correspond very closely to the 20-day moving average, acting as a resistance level, acting as a support level as well over here at 67.30. So only a breakdown below 67.30 may expose further weakness on the intraday basis towards 66.90, 66.70 next. But however, if price action starts to going to break up above 67.70, then this ongoing minor rebound should continue to actually seek a retest at 67.95, the next near-term resistance level, followed by the minor swing high of 29th of August at 68.20. So that's for the Aussie dollar. So for the dollar yen, what's interesting of dollar yen over here is that yesterday we do have a very tight short-term pivotal resistance level at this 141.20 level, 141 20 level mark over here. It broke out, almost hit the next the next resistance level at 143. Then it's horizontal at 143.70, which is also the 20-day moving average that is acting as a so-called resistance level at this juncture. So then overall, the price action over here, if you were to look at this RSI, so previous the RSI now is trying to break down, it's really breaking down below this parallel trend line support level. Okay, breaking down. All right, so indicating that there is a yesterday push up, no momentum to maintain, and price action starts to fall back down. But given the fact that given this is a US Federal Reserve monetary policy meeting, yes, the short-term trend is still pointing down. Why? Because the price action still continues to trade below the 20-day moving average. And if you look at the daily chart of the RSI, all right, the RSI is also showing a rather lackluster price movement as well, as price continues to shape a lower high. Okay, over here at this juncture, all right, trading below the 20-day moving average as well. So given the fact that the bigger picture trend is still pointing down, we do not want to actually play a bounce, I mean a mean reversion rebound. So what I could do over here, there could be some kind of wild swing ongoing, but I will use the 143.70 as my short-term pivotal resistance. Why? Because instead of 143, because that actually comprises of more technical element. Firstly, we see a very clear resistance zone, resistance area here, tested 3 times, 1 time, 2 time, 3 time, can't break, and it continues this this ongoing short-term minor down move that is in place since 10th of September, and also the 20-day moving average that is acting as a resistance level as well. Okay, 2 key technical element that is much more significant compared to the 143 that is pointing similarly to this one. I mean, it's 2 different technical element on defining of resistance that is pointing to the 143.70 level. So using 143.70 level as my short-term pivotal resistance level, just to take care of any potential wild swing, we will still maintain that intraday bearish bias. A breakdown below 141.40, revisit this week low means i.e. this Monday low at 132.70, then potentially followed by the next near-term support level at 139 figure level slash 138.75 in short term or on an intraday basis. Only a price push up with an hourly close above 143.70, then that would actually negate or invalidate today's intraday bearish bias to see the continuation of the bounce or a start of a more pronounced mean reversion rebound, perhaps back towards the 50-day moving average from a multi-day perspective. But from a intraday perspective for today, the next level after 143.70 will be at 145.40, which is this dotted line here. So what this dotted line is, the former minor trend line support level from the low of 5th of August, and 27th of August now turns into a pullback resistance at 145.40. So that's for the dollar yen, and also the sum up the intraday technical outlook on the major dollar pair. So there's one particular interesting FX cross. So FX cross we move off the dollar. That will share with you all will be the Aussie yen. So what we could see over here is that the Aussie yen in fact now came that rebound that has taken shape since last Wednesday now is coming very close to the 20-day moving average, and as well as the 50% Fibo retracement of that previous decline over here. Okay, the previous short-term push down from 3rd of September to the 11th of September. All right, and what we could see over here is that given that price action is coming very close to the 20-day moving average, and there was a bearish reaction of it right now, so I'll be using so there could be what I call potential intraday bearish bias that is unfolding on the Aussie dollar using Aussie yen, pardon me, not Aussie dollar, Aussie yen. I repeat, there could be a potential bearish bias on the intraday basis unfolding on the Aussie yen right now. That means, i.e., that ongoing rebound, that rebound that has taken shape from 11th of September low may have reached a tipping point where there could be a minor bearish reversal, all right, or bearish bias unfolding. So using 97.10 as my short-term pivotal support level. Pardon me, I begin a bit of tongue twisting today. Using 97.10 as my short-term pivotal resistance on the Aussie yen, there could be a potential intraday bearish bias unfolding on the Aussie yen. First near-term support level to watch 94.80. A breakdown below it exposes the key minor support level that is in place since 11th of September and 12th of September at 93.65. Only a push up with an hourly close above 97.10 will invalidate this intraday bearish bias on the Aussie yen to see the continuation of this mean reversion rebound to seek a retest on the 50-day moving average, which is coming close to this resistance level at 98.60. Right, so that sum up the technical short-term technical trend bias on the intraday basis for the one of the cross pair to take a look at will be the Aussie yen. Okay, so with that, now let us focus our attention to the major stock indices, starting with the Hong Kong 33. Just bear in mind, today the Hong Kong stock market is closed for a public holiday after yesterday's mid-autumn festival. So this year is a bit strange. They don't close on the exact day of the mid-autumn festival, but they close the day after. Right, so the Hong Kong stock market is closed, so there's no trading in the Hong Kong 33 index right now, and even during the US session. So no change on the key levels to watch out for ahead of tomorrow's opening session. Will be at 17,730. That will be our short-term pivotal resistance that we have yesterday. Still looking for an intraday bearish bias. The near-term support level to watch out for will be at 17,510, followed by 17,390. But if you see a gap up right after today's tomorrow Asia session open, then this intraday bearish bias will be invalidated. The next near-term resistance level to watch out for will be at 17,930, which is the 76.4% Fibo retracement of that previous minor down move from 30th of August all the way down to the low of 11th of September. Now, what's up next for the Nikkei 225? So the Nikkei 225, Japan 225, no change. Price action managed to continues to hold below the hold at the tightened key short-term pivotal resistance that we have yesterday at 36,780, and in today's Asia session it shaped a bearish reaction of it as well. So then the RSI continues to print a series of lower high, okay, since yesterday. Right, yesterday. So no change. Still, for sure, this is indeed the short-term tightened pivotal resistance that we got to take note of on the Nikkei 225. or i.e. the Japan 225 over here. So still maintain that intraday bearish bias as long as 36,780 is not surpassed to the upside. First near-term support level to watch will be yesterday's minor swing low, 35,860. A breakdown below it exposes the minor swing low of 5th of September and 12th of September, acting as the next near-term support zone at 35,400 slash 35,115. Only an hourly close above 36,780 will invalidate today's intraday bearish bias on the Japan 225 to see the continuation of that rebound scenario to expose the next near-term resistance zone at next near-term resistance level at 37,170 and even 37,570 on the intraday basis. So that's for the Japan 225. Turning our attention to one of the major European stock index will be the German 30 or the German DAX. So the German DAX yesterday, we do have a bullish bias. So the bullish bias almost hit our resistance level at 18,820 level, 18,820 level. And what we could see over here is that the hourly RSI, if we take into account of this, it starts to break below its parallel trendline support level, and there was a retest of it during yesterday's today's Asia session retest over here. So with that, right, it seems to us that there could be a chance of at least a minor decline taking shape due to this lackluster or a bearish observation that is being depicted in the hourly RSI, indicating a lack of intraday bullish momentum to push the price action much higher potentially. So using 18,820 as my short-term pivotal resistance on the German 30, we will flip to a intraday bearish bias. First near-term support level to watch, which is yesterday's short-term pivotal support level, 18,600, which is close to the 20-day moving average. A breakdown below it potentially may see a deeper intraday slide to seek the next near-term support level at 18,390, which is also very close, confluencing with the 50-day moving average, I think, as a support level as well. Only a push-up with an hourly close above 18,820 will invalidate today's intraday bearish bias to see the continuation of this impulsive up move to retest the current all-time high area at 18,970. First step, at a breakout, a push up above 18,970, see a potential next resistance at 19,190. Taking into account of a fit, because there's no more clear past graphical resistance, so this will be a uncharted territory in terms of price action. It will be defined by a Fibo extension level, potentially 2 times a Fibo extension level at 19,190. So that's for the German 30. Now turning our attention now to the major US stock indices, starting with the Wall Street 30 or the Dow Jones Industrial Average. So the Dow Jones Industrial Average, yesterday we do have a bullish bias. It rallied up before shaping that intraday sell-off, and yesterday rally hit the lower limit of our resistance that we highlighted. So we highlighted yesterday at 41,810 slash 41,950, which is the Fibo extension level. So yesterday it printed a high over here. If you go, the intraday high was 41,840. Okay, we fall into our resistance zone as well. So using that, and as well as what's interesting, that after it printed a fresh all-time high, a higher high, okay, this high higher than this high, but the RSI is not replicating the price action movement of the index. Instead, it shaped the opposite movement of a lower high, so indicating that yesterday's bullish momentum has eased off as well, which increased the risk of at least an intraday minor slide to retrace this recent push up from 11th of September all the way up to yesterday's intraday high, at least certain portion of this rally in the first step. So with that bearish element that's being flashed out on the hourly RSI, I'll be using 41,810 slash 41,950 on the US Wall Street 30, i.e. the Dow Jones Industrial Average. This will be my short-term pivotal resistance level, 41,810, 41,950, flip to a intraday bearish bias for a potential, we call it intraday slide to unfold. First support level to watch for sure, 41,535. That was actually managed to help yesterday, 41,535. A breakdown below 41,535, potentially see a retest at 41,105. Near-term support level, we also confluence with the rising 20-day moving average. And if you do the Fibo retracement of this most recent rally from 11th of September all the way to yesterday's intraday high, that confluence with the 38.2% Fibo retracement. All right. However, if price action starts to push up with an hourly close above 41,950, then today's intraday bearish bias will be invalidated to see the continuation of the impulsive up move to seek the next near-term resistance level at 42,335 slash 42,410 on the intraday basis. Now, with that, Nasdaq 100. So on the Nasdaq 100, no change. Price action yesterday rallied and hit exactly our short-term pivotal resistance before shaping that bearish reaction or that bearish intraday sell-off, coming very close to our first support level at 19,320 before bouncing up back up again. But what you could see on the hourly RSI continues to be rather lackluster, shaping that lower high, that continuous of a lower high scenario. And also yesterday there was actually a very clear bearish divergence that's being flashed out as well. Okay, price action shape higher high, but the RSI shape a lower high. Okay, and today's Asia session it continues to shape a lower high as well. So with that bearish element, that continuation of that bearish observation being flashed out on the hourly RSI, we will still maintain that intraday bearish bias. For sure, the 19,630 would be indeed an important short-term pivotal resistance to maintain our intraday bearish bias. First support level to watch again will be at 19,320. Only a breakdown below 19,320 may open up scope for the next near-term support to come in at 19,090 on the intraday basis. If price action starts to push up with an hourly close above 19,630, then this intraday bearish bias will be invalidated to see the continuation of the recovery in Nasdaq 100. So in first step, the next resistance level to watch out for will be at 19,900, which is the minor swing high of 21st of August and 22nd of August. So that sum up the intraday technical outlook on the major broad-based stock indices across the globe. So now with that, let us turn our attention to the commodities market, starting with gold XAU/USD. So for gold XAU/USD, yesterday we do see that slide taking shape over here. Then after that it bounced. Okay, so the way it bounced, it continues to hold at the 2,553/2,545 short-term pivotal with support level that we highlighted. So still no change, still using this level here as my key short-term pivotal support level. Why? Because it so correspond to the lower limit of this minor ascending channel that price action is being oscillated in since the low of 9th of September. And how it reacted also at the upper limit of this minor ascending channel. Okay, so there could be a risk that it may do that intraday, a wild swing to test this level again. So I don't want to push my short-term pivotal support level to be so tight to yesterday's minor swing low. Oops, let me draw the line again to yesterday's minor swing low at this 2,561. So still using 2,553/2,545 short-term pivotal support level in case of in case of any wild swing. So as long as this level holds, we will still maintain our intraday bullish bias, as long as 2,553/2,545 short-term pivotal support holds, we will still maintain our intraday bullish bias on gold XAU/USD. First resistance 2,588/595, above it sees 2,600/2,606 next. Only an hourly close below 2,545 will invalidate today's intraday bullish bias to see it extending the minor corrective decline towards the next critical support zone level of 2,532/2,526, which correspond to the rising 20-day moving average, and as well as the former range resistance since 20th of August now turns into a key minor short-term pullback support level. Okay, so that's for gold XAU/USD. Lastly will be West Texas crude oil. So West Texas crude oil continues to shape that bearish reaction right exactly at our short-term pivotal resistance zone that we highlighted yesterday, 7220/7315, which also correspond to the downward sloping 20-day moving average. So still no change, still maintaining our intraday bearish bias on West Texas crude oil since there was a bearish reaction exactly of the pivotal resistance zone that we defined yesterday. Near-term support level to watch will be at 6890/6808 level. Okay, this minor swing low here and this congestion area here, and as well as if we do the Fibo retracement of this minor short-term bounce from 10th of September all the way up to yesterday intraday high, that also correspond to the 50% and the golden ratio of 61.8%. Okay, only an hourly close above the 73.15 short-term pivotal resistance zone will invalidate today's intraday bearish bias to see the continuation of this mean reversion rebound extending towards the next near-term resistance level at 75.070, which also correspond very closely to the 50-day moving average, and as well as this minor descending channel resistance that I drew from the high of 18th of July. All right, so that sum up the intraday technical outlook on West Texas Oil, and as well the intraday technical outlook on the various broad-based cross asset classes. So before we go, let's take a look at the economic calendar. So like I mentioned earlier, today's key event will be the US Federal Reserve Monetary Policy meeting. So let's take a look at calendar. What other events to look out for ahead of the meeting? So the one that could impact on the sterling dollar could be potentially the UK inflation rate that is out at 2 p.m. Singapore time. Market expecting the core inflation rate, that means excluding food and energy, to inch down much lower to 3.3%. No, probably not inch down lower, to actually slightly go up to 3.5%. Previously, it was 3.3%. Pardon me. So that's a July print, and market participant expecting it to actually inch slightly higher to 3.5%. All right, so that's 2 p.m. So it could impact the movement on the intraday basis on the sterling dollar. Then thereafter, we do have another ECB official speaking, ECB watch speaking again at 3:30 p.m. Singapore time. Eurozone inflation rate, that's the finalized one, but that shouldn't be much of an impact because it's more or less should be the same as the preliminary figure that was released about 2 weeks ago. Then thereafter will be pretty much quiet. And all the focus will be okay. Then we have one that's related to the oil price, which is the weekly US EIA Energy Agency weekly crude oil stockpile change for the week ending 13th of September. The data released at 10:30 p.m. Singapore time that could impact the West Texas crude oil price. And lastly will be definitely the all-important FOMC meeting. So do take note of the economic projection as well. We'll be releasing at the same time at 2 a.m. Singapore time in line with the decision of the interest rate cut. Then at 2:30 a.m. Powell will be speaking, and it will stretch all the way up close to about an hour, and that also could impact the movement across the major cross asset classes ranging from FX, gold, and as well as the stock indices. So that should actually be it. And early morning to Singapore time at 9:30 a.m. One key Aussie data to take note of will be the labor market data. They call it the employment change and the unemployment rate out at 9:30 a.m. Singapore time. All right, so with that, sum up today's daily dose of market insights. I'm Kelvin here signing off. I wish you all a great day ahead, and for sure we will speak again tomorrow, ex post FOMC meeting. Thank you.